first start off with Tata Motors. Profit nearly halved in the fourth quarter as the domestic sales slowdown added to the hurdles faced by JLR. Yatin Mota is with us to take a closer look at the numbers and what brokerages are making of them. Yatin, good morning. You spoke to the management as well. Tell us what stood out, but firstly, the numbers analysis.
Neeraj, if you look at the results broadly in line, there were no surprises. As expected, they had a 6-7% decline in the consolidated revenues. If you look at the JLR margin also, they came in broadly in line. We were expecting a JLR margin number of 9.5%, and that is the most important number that you watch out for. And they delivered JLR margin number at close to 9.8% versus the consensus of 9.5%. More importantly, the management commentary matters because it was the last quarter in which the results were announced, and now we enter into FY20 in terms of strategy and plan guidance by the management. The most important market, the most profitable market for China is something that the management discussed with us in depth and also with the analysts. More importantly, they do believe that from here on, the China profitability would improve. Last time they had posted a negative EBIT margin. This time they're expecting that not only the turnaround will happen, but more importantly that dealerships are also returning to profitability. Also, they have cut down on the overall working capital requirement for JLR in China, and because of that, they are hopeful that with the new launches coming in, the free cash flows would improve. In fact, they were talking about Evoque, which is a big product in China, and how that will aid the overall volumes as far as the China market is concerned. Now, talking about the second important market, which is US and UK. Of course, there have been challenges there, but despite all of that, they are gaining market share both in US and UK. They are doing better volumes than the peer set at a lower discount, which means that the realizations for the US market are improving significantly. However, the key headwind here is Brexit as well as trade war. These are the two hangovers probably which Tata Motors is looking at this point in time. More importantly, as far as the US market is concerned, that remains healthy, but a Brexit could impact the first quarter earnings according to the management, because they are expecting or anticipating that there could be a chance of a hard Brexit. As far as India market is concerned, again the management was sounding confident. Of course, the first half will remain muted like other auto companies, but if you look at the overall India strategy, they believe that they are not phasing out any diesel cars, something like what Maruti did. They are confident that volumes will come back into the marketplace once there is a normal monsoon, and probably post the election the demand will get bottlenecked to a certain extent. And finally, as far as BS6 is concerned, they are expecting that the pre-buying will aid the overall commercial vehicle business. Guidance, and this is something important that we discussed in the yesterday's press conference and interviews. The guidance is maintained at EBIT of 4 to 6% for FY20. When I asked the management, were they confident of delivering 4 to 6% EBIT margin, given the fact that there is Brexit, trade war, diesel car issue in Europe, a lot of other things, they said that it is possible, since a lot of working capital will get reduced. More importantly, their cost-cutting plan in FY20 would deliver significant amount of profitability for them, which makes them believe that 4 to 6% EBIT margin is still achievable as far as FY20 is concerned. Brokerages, they remain negative. CLSA maintains a sell on Tata Motors with a target price of 150. They do believe that JLR outlook remains weak and cyclical pressures are seen as far as India business is concerned. They have cut the FY20 EPS by nearly 18%. Similar is the case with UBS. They maintain a neutral with a target price of 200. They say that JLR margins were above estimates, while India was slightly below expectations. And also, more importantly, the net debt reduction which happened in the fourth quarter is largely seasonal, and capex cut will help a little as far as free cash flow generation is concerned. So the brokerages remain slightly skeptical. However, the management does believe that there are opportunities in the marketplace, especially for markets like US and China.